Good afternoon. I welcome you to today's Trading Spotlight Hot Webinar. In fact, Trading Spotlight / Hot Webinar. Today here, it's Wednesday. It's the 17th of November, 2021. And what we want to do today is I want to give you some insights on how I trade the DAX40 right now, and give you some insights, some thoughts on a yes, Darshan writes, let's rock the world. I love that. Yes, let's rock it. So I welcome you to today's hot webinar. So I want to give you some insights on how to checkle the DAX right now. So you probably have seen there was a sharp breakout on the upside, most likely driven by an upcoming expiration in the options market next Friday. And there was an elevated high short interest in calls here, short calls here, which probably resulted in some need to hedge the short exposure here and the short squeeze we currently witness. The question is, how can I profit from these breakouts here, in fact? And this is what I want to present to you today, give you some insight, and not just give you the thoughts here on that, but I want to show you first of all the backtest results. So based on a backtest I ran with this strategy, and then also give you the forward test results. So here, how the strategy performed over the last, let me just think, a little more than 2 years, in fact, and give you some insight into this. So before we start, and you watch the recording now on YouTube, please feel free to subscribe to the YouTube channel. Leave a comment in the chat box below. Leave a thumb up here if you like what you're witnessing in the upcoming minutes. Also, please feel free to share the video. If you're here now in the live event in Zoom, then please use the chat box and ask your questions within it, so in real time that I can answer them. And let's now jump right into the action here, and here have a look at today's topic. So how experienced traders trade the DAX40 right now. Let me just see. Yes, perfect. So this is the chat box. Many comments already here with the hello. This is exactly where you can ask all your questions. And so before we start, first of all, I want to give some information around Admiral markets here, respectively now Admirals, after the rebranding took place over the last months. An FX and CFD broker with over 8,000 financial instruments being offered. And in fact here, so I'm located in Berlin in Germany. Here in Germany, we consider Admirals to be probably the DAX expert, and probably the most competitive broker when it comes to DAX CFD trading, with the most competitive offering, 0.8 point spread during the main trading hours here, very quick order execution, very reliable, very stable platform here, MT4, MT5, very, very stable. You get, and this is a very interesting, global presence with support on local languages. Very interesting in this context because you are very likely to find someone talking your native language. In fact, I myself worked in a bank 20 years ago around. I was working in the retail sector. I had an international audience, let's say, so clients from all over the world. And what I usually had when sitting here in the office, it was like you see someone who wants to talk about a very sensible topic, money in this case, and what to do with the money, respectively, how to trade the money here, how to set up the account, and all so on and so forth. And I mean, even if English here in this context is not a big issue, still people feel more comfortable talking to someone in the native language, and this is something which is worth to point out here. So global presence with offices around the globe, fully regulated, fully licensed by the SISEC, FCA, by the ASIC in Australia, for example. And all that being said brings us to a very important aspect here, that Admirals is definitely a broker you should give a closer look here. So admiralmarkets.com for further information on the offering. The rebranding which took place mainly due to the fact that it's not just CFD and FX trading, but beside of that, invest solutions, for example, Admirals invest in this context, very, very strong when it comes to the crypto space also. So admiralmarkets.com, long thing short, give it a further and deeper look. It's one word, one broker. Here are the regulatory entities here in this context. So around the globe, you can find the presence from Admirals, but our main focus today should be on the DAX here. And so in this context, I want to give you some insights into the open range breakout setup for the DAX40 CFD here. I want to give you an example how it looks in the real world. So I'll go here through the presentation. The thing is that we could also today here look at the DAX, for example, and then present it. It's a setup which occurs every day, certainly depending a little on the volatility. If volatility is too low, so at least I want to see an index of 0.2% index reading, and therefore a 0.2% here, that the width of the range in this context. So that means if the DAX currently is trading at 16,300 points, that the range should be somewhere between 32 to 35 points minimum to have a range width which you can work with then in this context. But still, it's a setup which is available, in fact, available, quotation marks, I'm here every day. And so I want to give you here the example in the presentation, how it looks in the real world. We could also switch over to the MT5 here and then have it look here in the real world from today. But I motivate you to do this yourself to get a feeling already for how to spot the setup and the range then. Then I want to show you that after I spotted it, you probably remember we had a presentation last week when I combined the best of two worlds, discretionary and automated trading. So this approach, in fact, is very easily automatable, let's call it. So you can easily formulate a setup based on the parameters and formulate an expert advisor and use it then in your trading to generate trade signals here, respectively the resulting trades automated. But then you certainly want to see whether this performed well in the past. So your observation, if it works, and then we have a look here at the backtest result. But not only that, the next step, I also want to give you here some further thoughts, respectively, how it performed in the real world on the real trading conditions with trading the approach, and give you, in fact, something we then refer to forward test. The interesting thing about this is, and this is something you will see, that we were capable of stabilizing the parameters from the backtest results in the real world under real trading, real market conditions, real trading conditions. And then in addition to that, I also want to give you some thoughts on how to smoothen the equity curve. Though if you want, this is kind of the discretionary touch we were talking about already in the last webinar last Friday. And then I also want to close the webinar, in fact, with a summary and show you how to profit from this acquired knowledge then in your trading. So first of all, let's have a look here at the setup itself. So how the setup can be found, respectively, which key parameters are used every day. If you want, by the way, if you're looking for a profitable trading strategy, we'll see that it works in the upcoming slides. But if you now are looking for a way also to get a foot into the world of, let's say, automated trading, for example, if you were looking for, so you're probably a coder or you're a programmer in this case, or an MQL in this case, so the programming language we use to set up expert advisors, you can screenshot here this and then write the code around these parameters. So these are the key parameters which the strategy, in fact, consists of. And what we do is we define the open range in a time window between 8 a.m. till 9:05 a.m. German time, so Central European time, CET. This is very important, in fact, because this differs. For example, the same approach, you will see this, that will be a webinar in the next month. I will show you some further consideration here for the US equity markets, and in this case, the SP 500, for example. Certainly, the open range there is different from the one here in Germany, from the DAX. That has something to do with, in fact, when the spot market comes to life, in fact, and when once active trading starts. So you can look at it that way. So 8 a.m., this is like the starting point for institutional traders. Very similar to, for example, institutional trading in the US. You've probably witnessed several webinars in the past, and during these webinars, and also today, in around 10 to 15 minutes, I will say, well, please wait 30 seconds. I have to look up something. I have to type down some key parameters I use for my trading. And these key parameters are, in fact, that I want to see what the institutional traders are doing. What's the pre-market volume in certain stocks I'm looking for today? Today, for example, it's Lucid. Probably some of you have followed the action there. Rivian after the IPO, Lucid, all the electric vehicle producers are currently running really hot. And so based on that, I focus on trading these stocks then around US equity trading hours. And so the same is true also for the DAX then. So institutional traders come to life, and we see some action. The market is bouncing around and forming a so-called range. And then the spot market, the Xetra open, is at 9 a.m. German time. So this is when Xetra opens. And Xetra open means in this case that there's tons of volume pouring into the market right from there. So it's like there's not much action between 8 till 9 or 8:59 in this case. In the first 59 minutes, there's not much happening. In fact, sometimes yes, but all in all, it's a quite dull environment, not that volatile. And then right at 9 a.m. German time, there pours the volume into the market and the spot market comes to life. And then we see some erratic moves on the up and down side. And there's a first filter I use here. So I want to filter out the noise and potential fake outs in this case. So we're looking here at the breakout approach, and I want to filter out the noise around fake out moves. So I want to wait after or for the first 5 minutes what the market does, pushing on the upside, downside, pushing upside, downside. And then I have a high and a low I can work with then and formulate then a trading setup based on. Therefore, as you may have guessed, we need an advantage. So advantage means, are we on the long side today or are we on the short side? And therefore, I use a very simple approach. In fact, I use an exponential moving average here, so an EMA, and in this case, it's an EMA 50 on a 5-minute time frame. And the approach is very simple. In fact, I say, well, if we're trading above, I consider the market to be long and the intraday advantage be given on the long side for the day. If we trade below, then it's the short side I should favor. And this is how I identify my advantage. And then based on the knowledge about or around the overall advantage I have in the DAX, I then decide whether I trade the breakout out of this range I defined in the step before on the upside or on the downside. And the stop is then above, respectively below, depending on whether I'm long or short here. Below the range or above the range. And I'm working with a predefined, this is the next step, I work with a predefined risk reward ratio in this context of 1 to 2. There's also some ways to adapt this. It's not sad that you should only use this here, but you probably remember when we talked here about the best of two worlds, discretionary and automated trading. You probably recall that I said, well, now, if you have this basic setup, which we will see is profitable, you have this and you know this, now the discretionary touch can come to life already. So probably there's a market environment, for example, the current environment we find ourselves in. So really use the current market conditions, because then the knowledge I provide here can be used in an even better way, because you see that the context, it's context depending then. For example, right now, I already said this at the beginning of the webinar. Well, we have a small expiration next Friday. So it's not the big expiration, the so-called, in Germany, we call this Hexensabbat. It's like a triple witching in the US. And options, for example, expire, but also futures expire. In this case now, it's only options expiring. And then you can find free sources from the Eurex, for example. This is where the future DAX is traded. You can see the open interest levels. And so usually what you can do is you can say, well, if a certain level is broken on the up or on the downside, in our case, then right now on the upside, well, there's probably some hedging being needed from institutional players who bet that we won't break above that level till this day of expiration, the third Friday each month then in this case. So if we know break above that level, well, these participants have to buy the DAX here to hedge their losing position in this case, which is then adding, especially if we're breaking to new all-time highs, adding to the overall bullish drive we see in the market, and the market continues to trade higher. This is especially true. Look at the chart. Last week, for example, we had a high that was around 16,120, 130, something like this. And then we closed above that level on Monday. So it wasn't that we dynamically broke above that level, but we traded slightly above that and we held there. And the interesting thing now is that we then saw directly from 8 a.m. German time yesterday. So today is Wednesday, yesterday was Tuesday. You saw that the DAX continued to trade higher, continuously traded higher, and never stopped really, but continued to trade higher also today. And as of now, we're trading 200 points higher, around 16,300 points. And why do I say that? Well, because now imagine that you're working with a predefined risk reward ratio of 1 to 2 here. And probably the risk reward says, well, the take profit, let's just give a number, is 16,150, for example, and you're taking profits there. Great, you made money on the trade, but you could have made even more if you intervened there from a discretionary perspective. For example, using an indicator, super trend or something like that, volatility based and trend following technique here, and then tried to increase the overall and the average winning trade in this context. So this is already one way how you can make the best out of two worlds. You know that this approach, which is easily automatable here, is profitable, as we will see. And then you can adopt here and try to smoothen the equity curve already based on that approach. And let's now look here into a chart and give a better idea of how this works. In fact, so this is an example. It's combining human pattern recognition. So you realize that there's a pattern occurring. It's a pattern which is already observable, or you could already observe it 30 years ago with Toby Crable. You probably recall that this was a name from a guy I mentioned during this webinar. And so here is the DAX in this case on a 5-minute time frame for yeah, I'm not even sure when that was, something like half a year ago, so it doesn't really matter. So this is already, you can see that happens over and over again. And so what we have here in red, or these is two horizontal lines, this is the open range. So this is the high and low between 8 a.m. till 9:05 a.m. German time. You have the high and low here, and then you have the moving average. This is the EMA in this case, EMA 50 on a 5-minute time frame. And now you can see, even though it was very, very close, but you can see that there was a close below the 5-minute EMA 50 on a 5-minute time frame here, which means that we have a sell stop in the market with a stop above the highs. So you have here the open range between 8 till 9:05. And then what we do is with the break here below, in this context, the open range on the downside, we are then entering the market. And by the way, let me just take this out. This is a little irritating. What's the reason for that? So let me just go once again. So I enter the market here with a break lower, and then I have the exit point here with a risk reward of 2 to 1. So just to give you here, let me just do the following. One sec. So I just snip this out and just give you an idea on this here. Okay, this is 1R. And then what you do, let's assume this is 30 points. You duplicate this. Okay, so 1R, let's say, equals to 30 points. And if we say we have a predefined risk reward ratio of 2 to 1, and that means that our reward in this context will be twice as high, so 60 points lower, which means that I have one range, and then I have another range of 30 points, which is 60 points. And this is then where we have the exit point. Okay, so this is in fact how it works, and played out really nicely here. There was no follow through, but you can find occasions like the one, for example, here most recently with the squeeze higher to new all-time highs. Here you could see that there's also the tendency sometimes, it's not happening over and over again, but this is exactly where the experience comes into play, your research comes into play, that the market then continues, in fact, to trade lower, and where you see a nice intraday trend developing here, which you want to capitalize on as good as possible. So you don't want to work here with a predefined risk reward ratio in this context, which already works, but still you want to profit from the then developing intraday trend. And this is where then some techniques like the super trend, for example, come into play. So that's how you recognize pattern then can be seen, or how to find it, in fact, how to spot it in the real world. And then what we do is we for example, program the approach here. So we use the key parameters I just presented on the slide earlier, and then we program an expert advisor. And then what we do is we backtest it. So we let it run over a certain period of time. In this case, for example, it's slightly more than 1 year. This is, by the way, a backtest I did in where I used this, in fact, for my German book. So I wrote a book in German on trading here, on how to build a profitable trading strategy, and DAX was part of this. And then here, this is where the backtest came from, in fact. And this is what the overall equity curve looked like. So now what's very interesting in this context is that you probably remember, this was already shown in the last webinar, so last week on Friday. So what we have here is the average winning trade. So this is, by the way, German, so don't be surprised. This is, the MetaTrader here was a German version of the MetaTrader. So the average winning trade is 157 euros, and the average losing trade is 99.70. That's a very important number. Let me just write it down here. So we refer to this as the payoff ratio. So the payoff ratio is the average winning, or average winner, it's probably better, divided by the average loser. And so the POR, the payoff ratio in our case, is 157 divided by 100, which equals to 1.7 for 200 trades in this case. So let me just go back here. So it's where do we have a number of trades? Here, it's 225 trades. And so this is the payoff ratio we got there, 1.57 in this case. So average winning trade divided by the average losing trade. Hit rate in this case, also very interesting. Hit rate for this time span, you can see it here. It's 41.78. So let's round this to the next full number. It's 42%. So obviously losing rate then is 58%. You will see why we type down these numbers, because now this is already impressive. So it works, obviously. So very simple approach. In fact, you have a clear range. Still, you wonder, well, does it work? So in the real world, under real trading conditions, sometimes you face slippage, negative slippage, so bad order execution. This is one of the reasons why you need a reliable broker, a broker who executes your order properly, who makes sure that you can execute profitable and that you can execute your strategy as you need it to execute, or needed to be executed here, so that you can still make money. So that being said, delivers, 1 second, by the way. I'm sorry. 1 second. Okay, so this is now bringing us to the next point. So we can see that it worked in the past, and our pattern recognition already played nicely, but still we don't know whether it executes also that way and very good, where very solidly in the real world. And that being said, I traded the strategy live, so under real market conditions here. So time span was the 24th of September till the beginning of October. So that was, by the way, when the switch occurred here from DAX30 to DAX40. Didn't make a difference, but this is why you see a cut here, because after that, I had to how can we say that, recalibrate, or so I had to change the input parameters for the expert advisor, and so there was a cut in my documentation, which I do, by the way, here via FX Blue. So it's automated that we do that, and so you have another 2 years here now, and now it's another 467 trades we did. And as you can see, and these are real stats, so these are real numbers, which I include here in the presentation. So the hit rate came, in fact, in at 40%, around 40%. So it is, in fact, very similar to the one we had here in our first backtest result, which we used then as a fundament for our trading. And the payoff ratio was, in fact, 1.5 to 1. So slightly less than that. So the overall profitability of the approach dropped. Why? Well, hit rate is slightly lower. but only slightly lower, while the payoff ratio here came in slightly lower. That means the overall expectancy of the strategy is slightly lower, but still it's profitable. So we can calculate this here. You can calculate this, by the way, yourself. So it's still a rising equity curve. So 0.4 multiplied with 1.5, you get 0.6, and then, oh, I'm sorry. That's, yeah, I should have, that was a rounding error. Yeah, that 1.52, because then it's 0. That's a little, yeah, that's unfortunate. I'm sorry. Now I see the problem. 1.52. It needs to be 1.52, in fact. So that was something I wanted to include before the webinar. I forgot to include it, because now you will find out if you calculate based on these parameters, you calculate the expected value, you get 0. So it's like trading around so there was only a small positive expectancy in this case, very, very small, in fact, but it was great enough, small, but still great enough to produce a positive result here in this context. But you certainly have to see then 1.52, still below 1.57, but again, in this context, it's necessary to include this, because else you will see, well, this is 0, which doesn't make sense at all, because no, it's not after commissions. In fact, it's already included. Commissions are included. Yeah, that sounds now a little ridiculous, but it's a very good way, in fact, to see why there is a need for a discretionary intervention. That's probably a better way to put it. So it's a very close call. It's very close to, so let's call it break even here in this context. And now the question is, what can I do to improve the strategy? So therefore, you can already see this here. So documentation of the trading is necessary. It's very, very important. For example, by using FX Blue, for example. So by the way, let me just, yeah, I'm talking about small positive expectancy, but let me just show that to you, what I'm talking about. So expected value, that's probably a better way to put it. So expected value is defined as the average winning trade multiplied by the hit rate. And then you have the average losing trade here. Multiplied by the loss rate. So now you can already see losing rate. You can already see that if I type in, let's shorten things up. So EV here, if I say average winning trade is 40% and multiply it with 1.5, and then I subtract the losing rate, and I have here 0.6. You can see, I'm sorry. Then obviously I get 0.6 minus 0.6, which equals 0. So there's no positive expectancy at all. And that's why we have to add here 1.52. 1.52 now, let me just type this in, 1.52 multiplied with 4, it's 608. So that's equaling to, is that right? Let me just see. 0.6. There's a 0 missing. So that means that per trade after commissions still, but here that after commissions, this is greater 0, but it's only slightly greater 0. That means that we are making 0.8 cents per trade. This is a positive expectancy we have, which is close to 0. So it's very, very, very small edge, but still it's greater 0. And our target now is to find ways to increase this number here to a level where we can say, okay, this is based on which we can do our trading, build our trading on. By the way, now let me just here look into my tool to track the criteria and run my trades. So Lucid just traded 26 million shares pre-market. This is astounding. This is nearly 50% of the average daily trading volume, minus 1.1%. So holding the most of the gains from yesterday, this massive run higher. Let me just also see Target is another stock, over 1 million shares being traded. Sales earnings were solid, but the thing is that it already ran quite well over the last months, and Target is probably, or is in a very similar business as is Walmart. You probably have seen that Walmart also delivered very good earnings yesterday, but performed not that good. And that being said, brings us to the point that probably Target will see a further drop on the downside, probably an attack at 250 today. But let's come back here to this presentation. So it's a small edge. It's a very, very small edge. And now what you need to do is you need to somehow increase this. And so this is now a concept which brings us to a very, very interesting concept here. It's how to smoothen the equity curve based on trading research, respectively technical analysis and Dow theory to some extent. So the question is how to find, or in our case, we already have an advantage, a small one, but still how to find the advantage, probably respectively increase the given advantage here. So, and therefore what we need to do is we are trading on a 5-minute time frame. So what we want to do in this context is then we want to have a look here at our so-called dominating time frame. And the dominating time frame from a 5-minute time frame is the hourly chart. So this is where we want to have a look at then. And then what we do is, first of all, what we need to understand is that there's areas of accumulation and there's areas of distribution here. So if we identify on an hourly chart that we are currently trading here in the so-called accumulation area, then we want to trade this breakout approach aggressively, while we want to decrease the position size if we are finding ourselves in a risk-reward unattractive environment, the so-called distribution area, respectively. We want to be more aggressive in distribution areas here once we trade anti-cyclical, so against the advantage we find in the dominating time frame. What do I mean by that? Is quite simply, so therefore this makes more sense to have straight away directly a view here on the distribution area concept, respectively the accumulation area concept. So what we do is we here in this context, sometimes people will say that trading the breakout to new highs. That sometimes makes sense if there is a significant breakout occurring then, and there's strong momentum in direction of the overall given advantage, which you can see here, higher highs and higher lows. The only problem with that is that we are position ourselves in an environment where many other market participants probably will look to enter a trade on the long side, respectively exit a trade once they position themselves against these highs and bet on the market forming kind of a top or something like that. So that being said, brings us to a point where you can say from a risk reward perspective, entering a trade here is not very attractive, but what you want to do is, in fact, you want to trade, let's call it, into the retracement, and then try to profit from a move up to and a break above or two new highs then. So which means like you facing here, this environment, higher highs and higher lows, you see the pull in, the market starts to turn here in this area. And then you start to build a position in the so-called accumulation area here. So that's why it's green, because the risk reward is very favorable. Just imagine you position yourself here with a stop slightly below the last so-called swing low in this case. So here, and then position yourself already here long in anticipation that we see a run, a retest of the former highs in this context, or former lows in case of a downtrend. And then probably thinking about adding to a position once we stabilize slightly below here, for example, which means that if you already had a position from here, the average price is significantly lower than if you enter the trade right away here in this area. While obviously, if you already broke to new highs, then you have the distribution area here, and the market is already very extended on the upside. So for someone playing the higher time frame, so bigger players, especially institutional players, what you certainly see here is that the risk reward is getting very unfavorable on the upside then for long engagements. So you should be really careful. Respectively, market participants should start to probably think of going aggressively after the trade, after a long trade here with their stop, respectively. They're so-called mean reversion traders, probably betting that the market will rather soon or later see a sharper drop here in this context. So that being said, let me just here probably open another slide and do some drawing. That's probably a better way to put it. So as I pointed out, this is the H1, and you want to position yourself here in this area. So let me just put this here. So this is the hourly chart. This is the dominator of our 5-minute chart. And then you see the market here coming into this area. And now what you probably want to know is, how does the price action look like in our time span? So in our 5-minute time frame, let's probably here do this blue. So how does it look like, what we get to see here? So what we get to see is the market is obviously falling, and then it starts to build some kind of a bottom, breaking higher here, and then rather sooner or later reversing. So this is exactly what we get to see here. You see? So this is like the hourly chart, while this one here is the M5, and what we probably get to see here in this area. So the market already came here from, let's probably do this in, probably, oh, I'm sorry. Let's go back. So let's do it here. So this is the black part. Okay, so this is where the black part comes from. Okay, so probably a little longer than that. And then the market starts to turn. And this is what you get to see here, the small time frame, but there's more candles on an M5. So one hour is 12 M5 candles, obviously. So this is what you get to see then here in this area. And if we get to see this, and now let's assume, for example, that we have our range, our open range, for example. No, that's wrong. Let's assume that this is our open range now. In this area, the first 1 hour of trading for the trading day. Well, what you want to do if you find yourself here in an overall long environment, so hourly, you can see the advantage being given on the long side, higher highs, higher lows, and you're trading into the retracement, where obviously you can see here, there's a potential bottom forming. So market participants are losing their interest in shorting the market or selling the underlying asset, in this case, the DAX then. Market is starting to bottom out, and this is the price action you get to see then in the first hour of trading, 8 a.m. till 9:05 a.m. German time in this case. So the open range is forming. These are the horizontal red lines, and this means that you're more aggressive to build a position here with the breakout out of this range than you would do if, let's say, the same picture, let me do it that way, it's again the hourly chart. If the same picture occurs here. So just assume now that what you get to see, let me just do it that way, that we get to see here, and we are already coming that way. Oh, I'm sorry, no, that's wrong. And we are already coming that way. So now we are coming higher, and you see already the market very extended. Would you now aggressively trade here in direction of this already very extended mode on the hourly chart? You probably wouldn't. You would probably say, well, I reduced the position size, but I probably think about, if I see this extension here, probably think about trading a break lower more aggressively, since we are likely to see a sharper bounce, a sharper retracement here. So which means I probably will start to look for a very, very aggressive way to trade a breakout here on the downside out of this range. So this is how you can understand this, how you can understand the theory behind this concept of distribution and accumulation area a little better, and put this in the overall context. So it's not just that we're trading the 5-minute chart, but a good and very, very strong way to increase the overall expectancy here in your trading is by saying, hey, you know what? I reduce the position size if we're trading in the so-called, let's go back here to the presentation. I reduce the position size if we're trading in an, let's say, risk reward wise unattractive environment, distribution area here, once we tend to trade in direction of the overall environment, respectively, I will trade more aggressively if we're trading in the accumulation area. The same is still true. You could also say, hey, if we see that the market is trading slightly below the recent highs here, which are all-time highs, and where I know, for example, that the expiration will take place and there's a high short open interest, and on written calls, for example, you see a tight consolidation below that level. Well, also here, you're probably willing, even though you might say, well, in the longer time frame, on our dominating time frame, well, this is not that attractive to trade long here. But then you put this into perspective and say, hey, there's some need to hedge an exposure, a bet, which will expire next Friday, and which will cost probably some institutional players lots of money. So that's why you trade a potential break higher to new highs then more aggressively in case of an open range. If you probably trade it, if you probably trade here somewhere in this area where the follow through on the upside is more is unlikelier to in fact happen. So okay, I see. Yeah, I know that there's some. Thank you, Gertz. In this case, I'm not that keen, or I'm not that good in using here the how can we call this, the drawing tool in Zoom. I know that there's a function, but I prefer to use it as I did here because I'm used to use it. So and I know what I'm doing there. So but thanks for the tip. So I will probably look into this. Yeah. So any questions? Again, if you watch this on YouTube, feel free to ask the questions. If you have any questions related to what I just presented, please feel free to ask them in the chat box below. I'd be more than happy to answer them. That is also true for all of you right now watching this here. Probably this is a concept you haven't yet thought about in depth, but it's probably something, it can be really a power tool, especially coming back again here to the expectancy of this approach. So a very, very small advantage, very, very small, but still, there's a chance to increase the overall profitability of this basic approach and use here the discretionary tool in this case, which will be very difficult to program, in fact, because it's very difficult to, in fact, here, how can I say that, to code the distribution, respectively, accumulation area idea behind this. So that being said, probably it's one way to optimize your trading and smoothen the equity curve and guess, respectively, increase the overall positive expectancy of a trading approach. And so now, again, what can you do to profit from this knowledge? So first of all, hopefully you learned already something and can profit from it in your trading. But the next thing is also to somehow use this and also use this as a fundament to increase the overall likelihood, not probably necessarily this approach, but probably your approach you optimize for yourself. And probably I can give some details, some thoughts on this also here. So what we could say is use the strategy, respectively knowledge, here as a profitable fundament, and then fine-tune the approach, so the basic approach, the open range breakout approach for the DAX, and in this case, fine-tune it with your personal preference system. And in this case, you can also say, I can use the strategy, in fact, to get to know a so-called trading routine here and I can go through every day, journal my trading, and try to improve my trading thanks to real results then. So hit rate, payoff ratio, and so on and so forth. Once you know these data, you only know it once you journal your trading accordingly. Well, you have the chance then to really gain control and security in your trading and build a high level of self-confidence. So it's not ego trading and I'm the greatest trader on earth, but it's more like I know what I'm doing, and that's why I can improve and I can get better in this context. Now, the idea behind this here can be found in this small picture, in fact. So it's like what you do is you document your trading, in fact. In this case, for example, 20 trades in a demo account, you try them. And you have the setup, which you already produced at the beginning. And then we write down all stats, all data around this. So we, for example, use FX Blue. We connect our trading account, our MT4, MT5 here from Admirals, for example. We also use the Supreme add-on, the connect solution there. You get info. We gather stats then. And then what we do is we review and analyze these stats. So I see the advantages given, but it's a very small one. So what can I do now to improve? So what can I do to make it better, also based on my personal preferences, perspective of my personality, my character, my trading approach in general. I implement these changes, I improve, and then I repeat. I start over again. So, and do the same over again. I document the trading, 20 trades. I see, did I improve? What went good? What can be done better in the future, and so on and so forth. And that way you start to focus really, in fact, on the process in general. It's not result driven anymore, but what you do is you improve your trading based on a process you follow here to increase your overall expectancy in your trading. And finally, let's conclude here. The webinar with the approach again, and the definition of the open range breakout, in fact. So for a screenshot, if you like the setup and you want to fine tune it for yourself. So we use the open range between 8 till 9:05 a.m. German time. And we identify the advantage based on the 5-minute EMA on a 50 aggregation here. So EMA 50 in this case. If we close with the last 5-minute candle above, then we trade only breaks on the upside of the range. If we close below, we only trade on the downside. And what we do is we trade the break of the open range in direction of the advantage we just identified earlier. And with a stop above, respectively below the high low of the range, depending on whether we're going long or short. And the position works with a predefined risk-reward ratio of 1 to 2. Again, what you then do using this approach is you try to optimize it based on your personal preferences, using, for example, distribution accumulation area, for example, using, in this case, Dow theory concepts. In addition to that, you can also say, well, we are about to see a squeeze higher. I already presented another approach, for example, using super trend as a trade management tool, probably we can call this then, to manage your trade accordingly and let winning trades run, even though you cut losing trades already short by using a predefined stop level in this case. And yeah, take it from there. So that's it on today's webinar here. It was a pleasure. So if you have any questions, please feel free to ask them. Again, right below the video, leave a thumb up if you like what you just saw. Subscribe to the YouTube channel from Admirals. Fully regulated broker. Contact details can be found here in this slide, but fully regulated broker. That's why we have to close here with a risk disclaimer. And yeah, talk to you again, in fact, on Friday. So Friday, we'll have another webinar together. And let me just check, by the way, that the topic for the webinar, I already prepared it. So it's English, it's a hot webinar, it's November. And let me just see, we talk about paper trading. So in fact, we talk about paper trading. I'm a big fan of paper trading, by the way. So that's definitely something you also probably should tune in, and then I hopefully can present to you some insights into how you professionalize your paper trading and get the most out of it to have a good starting point in your real trading then. And all the best. Happy trading. Watch your stops. Have a nice Wednesday. Happy trading, and talk to you on Friday. Look forward to it. All the best. Bye-bye.